today. We are recording, as you just heard. Thank you. We remember to do that. So, yay. Exactly. I was just going to remind you. So a couple of housekeeping items before we get started. As you just heard, we are recording. We will have an opportunity at the end of Kara's prepared remarks to ask questions live. So if you do that, just know you will be on the recording. If you're more comfortable typing a question into the Q&A at the bottom of your screen, you can feel free to do that as well. Anne Marie and I will be looking at that box, and we'll let Kara know if we have any questions at the end of her prepared remarks. But welcome again. My name is Anne McCabe, for those of you I have not met, and we're excited to have you here today. Thank you for taking the time. I'm joined by Anne Marie LeBeau, who heads up the Rockville office, and of course, Kara Murphy, who I will introduce in a couple of minutes. So when Anne Marie and I invited Kara to come speak to our clients, we were thinking that it would be a great time to chat with you all and for Kara to share some of her thoughts, because it goes without saying that we've had a very challenging year so far, right? There's a laundry list of risks and of concerns and of things that the market is constantly going, up and down as a result of. But little did we know that she would be speaking the day after the S&P 500 officially hit bear market territory, which happened just yesterday. And for those of you who don't know, a bear market, the definition is a decline of more than 20% off a recent high. On top of the S&P 500 and a bear market, the 10-year Treasury bond yield hit a level we haven't seen in about 11 years. So it closed at about 3.3% yesterday. So we're seeing some challenges in the stock market. We're seeing challenges in the bond market. And so we're really excited to have Kara here today to shed some light on that. So I will introduce Kara. I will share with you all that I feel a special bond with Kara because she joined Kestra around the same time that we decided to partner with Blue Spring, at least the Reston office, which was about a year ago, right, Kara? Did you join?
Actually, today is my 1-year anniversary.
Oh my gosh, happy anniversary.
Yeah.
Look at that. Yeah. So we were June 1st. So we're definitely right around the same time. So Kara is Kestra Investment Management's Chief Investment Officer. Prior to joining Kestra exactly a year ago, she was CIO over at Goldman Sachs Personal Financial Management. And prior to that was CIO at United Capital and at AIG Funds. She started on the investment side as an equity analyst, but interestingly, before coming over to the investment management side, she was an analyst focused on international political and economic risk, focused on Eastern Europe and Russia. So probably some very interesting insights on what's going on over in Ukraine and Russia. Kara is a CFA and is a member of the CFA Society of New York, as well as Dallas-Fort Worth. And she serves on the board of directors of an organization called Welcome Home, which is a nonprofit she founded to support newly resettled refugees. She has a bachelor's degree from Georgetown University, which is right in our backyard here in DC, and a master's degree from University of Chicago. So it's my pleasure to welcome Kara Murphy. And Kara, thanks again for taking some time to speak with our clients.
Well, thank you so much. And, folks may have heard me saying I tend to be more in demand when markets are very volatile, right? Because that's when people start paying a lot more attention to their 401ks and their IRAs. And I know that's when I get the call from my mom saying, Kara, I'm losing money. So it works out well that these are good times to kind of touch base and hopefully I can provide a little bit of perspective in terms of what's happening. So we'll talk a little bit about comparing this period to previous periods. And I think certainly the level of anxiety goes up every time we see markets go down. And as Anne rightly said, it's particularly concerning because we're seeing stocks decline at the same time bonds are declining. And so often we sort of look to bonds during these volatile periods to provide some cushion in our portfolios. And it's not working quite like that during this time. So after the presentation, we'll take a little bit of time to sort of think about a little bit more what's happening more recently in the markets. So with that, let me share my screen. All right, can everybody see that okay?
Yep. Yep.
Great. All right, so we came up with this title of Not Your Mama's Market because, as I said, I often get that call from my mom when I'm driving home from work, and she's like, Kara, what's going on? It's just like, you know, and she'll remember the late 70s, which was a very traumatic and time of a lot of economic turmoil. So we got to thinking about, you know, what's similar or different between then and now. But before we get into kind of the current market environment, here's just a little perspective. This is already looking outdated because it's from the first quarter. And of course, markets have declined a fair amount since this point. But I think it's fair to say, looking at this, the theme has remained very similar in the second quarter, in that pretty much every asset class has been in decline over, like, so far this year, with the distinct exception of commodities. And so commodities kind of across the board have really soared over the last 18 or so months. And it's only become even more sort of striking as other asset classes have declined. And you'll see 1 year trailing. And again, this is as of the end of the first quarter. So numbers are a little bit different because of the performance of the last 2 months. But on a 1 year trailing, we still had US equity markets quite strong, with a lot of weakness in fixed income, with the exception of tips, which do well when inflation is increasing. And then emerging markets, which had really sort of suffered in 2021, largely because of China. So if you think back to the summer of last year, China was really cracking down on property developers. We had Evergrande that was going bust. Tech companies were coming under scrutiny. And then, of course, we've had multiple lockdowns in China that have really hit the economy hard. And so that stock market has suffered and kind of like pulled down those emerging market indexes with it. You'll notice here on a longer term basis, US real estate has still been quite strong. So that's been an area where a lot of people have looked to invest more to sort of find the safe haven in this rising interest rate environment. And then, of course, the commodity returns are even more striking on a longer term basis. So starting off this year, we had this theme of downshifting, where coming off of the COVID, the worst of COVID in early 2020 into 2021, we had enormous fiscal and monetary stimulus that was trying to sort of plug this economic hole when everyone went to shelter, not everyone, but you know, many people around the world went to shelter in place. And so we had this massive downdraft in economic growth. And so the US government, you know, sent out stimulus checks and a lot of other forms of monetary support. And then the Federal Reserve dropped rates dramatically to try and support markets during that time period. So you'll see growth in 2021 was 5.5%. I mean, that was an extraordinarily fast pace. It's a pace that we had not seen in decades. So coming into 2022, as it seemed like the worst of COVID was behind us, we knew that fiscal stimulus was drying up, the Fed was going to start to be more aggressive in tightening. And so it was clear that 2022 and 23 were going to be a much slower economic environment. So hence this theme of downshifting. And we had markets start off weak, right, as it became clear that the monetary environment was getting tighter. But then, of course, in February, we had the Russian invasion of Ukraine, which propelled commodity prices even higher than they had been at the start of the year. So then you had the Fed that was in this tightening mode. Inflation was getting ahead of it. And now you have commodity prices further complicating that by driving prices even higher at the same time that you have higher geopolitical risks. So the job for the Fed became that much harder in February. And in fact, since then, we've had more inflation readings that are even higher. So these numbers, they actually haven't changed that much since we first put this together. This is as of April. But so, the broad consensus still has growth in both 22 and 23, but those expectations have certainly come down as inflation has gotten worse and the Fed is looking to get more active. So with that, slowing growth, higher prices, you're hearing more and more about this fear of stagflation. So stagflation is when you have negative economic growth and prices continuing to go high. And now what's interesting is that, my career, 20 plus years in Wall Street, there have been multiple stagflation scares over that time period. It's never really materialized. The last time we really experienced this was in the late 70s, early 80s. But there are certainly, more and more references to the fear of stagflation and comparing this period to the 70s and 80s. So we figured we would take a closer look to kind of compare these two ideas. An annualized CPI rate, we actually just had a print last week for consumer prices that was a little bit higher even than 8.5%. But believe it or not, back in the late 70s, CPI was running even hotter than what we have here. At the same time, unemployment rate was almost double where we were. So the labor market was under much more stress than we have today. And overall GDP growth was faster than what we have today. And year-to-date increase in gas prices, so we were trailing that experience. We're probably about even with the year-to-date increase in gas prices that was experienced back in 1979. So there are some things that are quite similar, but the extremes of price increases and the extremes of economic growth are actually were more in the late 70s compared to what we're experiencing today. We also started to look at 1983 because that was an important part when we were starting to climb out of those twin recessions. And that's important not just because of, for an economic and market perspective, but it's because that's when the Karate Kid was released. So I'm a child of the 80s. This was a seminal moment in my childhood. Danny LaRusso was from New Jersey. I was from New Jersey. It was a time of like big hair, which being from New Jersey, I could certainly relate to, and muscle tees and, grabbing flies with chopsticks. And so, all this talk about stagflation in the 70s and soaring oil prices certainly brought us back to that time period. And during COVID, like many people, my family and I watched a lot of really campy TV. So my husband and I take our cultural education of our children very seriously. So we had them watch all three Karate Kids, and they really enjoyed them. But then we discovered Cobra Kai. I don't know if anybody has watched this show, but it's available on Netflix. I don't know. I think there are 4 seasons of it. These guys managed to bring back like every character from the original series, and they kind of weave this new story and have a new generation. And so there's a lot that's similar, right? So you have these familiar faces, you have black guys, you Walkman with mixed tapes, and little wax on, wax off for those of you who have seen them. So there's something that's very familiar about it, but it is very much a different show. And so this became sort of an analogy for the market today versus back then. There's a lot of parallels, but the way that the story progresses, the way that we can sort of anticipate where markets are going is quite different today relative to the 70s and 80s. So I wanted to dig into why that is, why we're thinking about these two periods as different. So that's how we came up with this idea of not your mama's market. My mom, of course, thought that I was talking about her when I told her the title of this. So we'll talk about oil and commodities because that's certainly the star of the show in the market today. Fed tightening, Fed is also a very important sort of character in this story. And then labor markets are also kind of front and center. And then a little bit about globalization. So, the early bird gets the gasoline first. I remember back in the late 70s, sitting in the back of my parents' brown station wagon, waiting in this long serpentine line to get gas. It was like, we were even, and it was the even day to fill up. And, we would watch neighbors get into fistfights because somebody tried to cut in line. And those were very strong memories at the time. And it was a pretty harrowing experience for folks who were sitting in those lines. And so I think for folks who lived through that, seeing these prices at the pump, bringing back shades of this gas rationing happens very quickly. But there are some very important differences between that experience versus today. First of all, when we look at gas per gallon, we inflation adjust it. And again, these numbers are a little bit dated already. So today, gas price per gallon inflation adjusted is actually higher than where we were back then. So if it's hurting when you go to the pump, yes, it is really high relative to historical averages. And in fact, my brother lives in California and has been sending me photographs of him at the pump with $7 plus gallon gas. And so certainly high. But the key difference is when you look at the fuel efficiency of today's cars versus then. So on average, cars take just one third the amount of gas that they would have in my parents' brown station wagon. So even though we're paying a lot per gallon, we're just using so much less than we were back then. And that, of course, doesn't take into account the electric vehicles, wind power. I live here in Texas where, so tied to the oil market, but Texas is one of the largest producers of wind power in the country. So we've been able to diversify our sources of power so much since then, and has been able to help insulate us from these really high levels. And in fact, these high prices from the 1970s and 80s prompted, for instance, like the 55-mile-an-hour speed limit on interstate highways, prompted fuel efficiency standards in cars, really promoted a lot of investment in these alternative energy resources because of that really harrowing experience. And so we're benefiting from that today, many decades later. Another key difference between then and now it is in this chart. So that blue line is consumption. So think about, since the 1970s, how much the US population has grown, but our consumption of oil is relatively flat. I mean, that's remarkable. That means our per capita consumption is a fraction of what it was 50 years ago. On top of that, you can look at that orange line. That's production within the US. So the amount of oil that we're pulling out of the ground within the US borders versus importing. And so this tremendous increase in production over the last 15, 20 years has really soared. And now we're basically neutral in terms of imports versus exports of oil. So as gas prices go up, US oil companies benefit from those higher prices at the same time that it's hurting consumers in the pocket. So it's a little bit more balanced. It's not to say that people don't get hurt by it, but that benefit sort of stays within the economy. And those oil companies are hiring, they're investing, and that sort of stays within the US GDP. So again, it makes us much more insulated from these higher rates. All right, so the Fed, no one's going to save you from the beast about to strike. So the Fed is often the villain or the savior in these stories about the market. And I grew up in the market with this mantra of don't fight the Fed. And it's often used in a context when, when markets are falling apart, when the economy is really declining, and the Fed steps in. Think about March of 2020, the Fed steps in and starts pumping in liquidity. Market participants will say, don't fight the Fed. The Fed's coming to the rescue, and they'll inflate assets. And that's very much what we saw in March of 2020. Now we're dealing with the reverse, though. Don't fight the Fed. They're withdrawing monetary stimulus. And so that is a huge drag on risk assets. And so there's been a lot of focus on the change in interest rates, which has certainly been rapid. But then when you think about kind of the overall level today versus back then, we're again in a very different place. The housing market has certainly been the center of a lot of sort of the boom and bust of the last couple of cycles. And it's an important way that the Fed transmits monetary policy. So for instance, as the Fed is cutting rates, mortgage rates come down, housing becomes cheaper, and you have people tending to buy houses. Now the opposite is happening, where the Fed funds rate is coming up, pushing mortgage rates up, housing is becoming more expensive. So we looked back to kind of compare the housing market today versus back then. Downtown LA in the 1980s, that's where Danny LaRusso, our hero from The Karate Kid, would have landed with his mom as they drove cross country. At that time, mortgage rates would have been 15%. So buying a home for Danny and his mom would have been out of the question given their economic situation. Even with a median sales price at $73,000, you're talking about a monthly payment on an inflation adjusted basis of $3,400 a month. Now, if we fast forward to today, mortgage rates, they're now a little above 5%, but at a median sales price of $400,000. So we've had tremendous increase in home prices over the last 2 years, and mortgage rates are way up. But even after those increases, your monthly mortgage is less than what Danny and his mom would have paid in the early 1980s. So, there's been a lot of talk about affordability, and we'll certainly start to see the housing market slow down. We've seen indicators of a number of different types of indicators suggesting some of the heat is coming out of the housing market. But in terms of affordability today versus then, it's still more affordable to buy a home than it was back then. All right, so Tootsie Roll Pops. These were favorites of my brother and I. And I have not yet been able to introduce my kids to these. We need to find some to show them. But they had this whole ad campaign about how many licks does it take. So it was kind of like ongoing joke. How many licks does it take before you get to the center of the Tootsie Roll Pop? That was the good stuff. So some enterprising university department came up with this machine that was gonna lick a lollipop and figure out exactly how many licks it takes to get to the center of the Tootsie Roll Pop. And it was something like 362. Well, thinking back to the 70s and 80s, there was this big tension between labor and technology. And there was a lot of fear that among the US workers that they were going to be supplanted by technology. So there was this debate about which was better, like the person or the machine. So the Tootsie Roll Pop ended up becoming the center part of this debate. So some enterprising college students then decided, okay, we're going to take the machine on and see how many licks it takes us to get to the center of the Tootsie Roll Pop. So for them, it was about 243. So in that case, the individual won over the machine. But this push-pull has been certainly ongoing over the last 50 years. And if you look on the left of that chart, productivity per hour of the US worker has pretty much been a straight march up. And this is really a huge source of economic growth and the ability of us to have growth and tamp down inflation. And American workers have just been incredibly resilient in being able to get more productive with every decade that has passed. In 2016, there was this paper that was published that I went back to recently, and it had gotten a lot of attention at the time, and it was making the argument that all of the sort of productivity and advancements that we had because of cloud computing and internet technology and whatnot, it was done. Like, yay, it's done a great job. We've had a huge amount of productivity in terms of American workers, but that's it. Don't expect any more. And then sure enough, fast forward just a couple of years, we have COVID where, almost overnight, a large portion of the American workforce is forced to work from home. And guess what? We're able to continue to become more productive through that, despite that setback. So this is just to highlight how this labor productivity has been incredibly important. And in fact, it's a big distinguisher between the US and Europe in particular, where you have many more restrictions, you have a much less flexible workforce, and the overall economic growth has been much more limited than what you've seen in the US. Another piece of that has been union membership. And this is not a value judgment on whether unions are good or bad. In fact, both my parents were parts of unions for their whole careers. But when unions are a larger part of the overall workforce, they tend to make the workforce a lot less flexible. So in 1983, union membership was about 20%. And during those recessions, during the oil embargo and stagflation, unions had sort of come to the table with a lot of company managements, and they said, okay, we know times are hard. We're going to give up some of our demands in terms of wages, benefits, hiring, all of that, so that we can all muddle through. Well, during that time period, companies tended to reinvest in technology. So they were able to replace some of those workers with technology. And then as the economy started to rebound, unemployment was still quite high. And so companies were able to go out and hire non-union workers. So 1983-ish, when unions came back to those managements, they said, okay, the worst is behind us. We want to reinstate some of these demands. The company said, no, I'm okay. We're able to go out and hire other non-unionized workers. And so that really marked the peak of power among unions and the percent of the US labor force that was in unions. And today we're at less than half that level. And we've seen a lot of headlines in terms of like Star workers and Amazon workers discussing unionizing, but really hasn't made a dent in the overall numbers. And again, like another key differentiator between the US labor force and the European labor force. European companies are much more reluctant to hire because it's that much harder to fire someone. And when you get into rocky economic times, American companies are able to right size their labor force much more quickly than European ones, but it also means they're more willing to hire when the times get good, and thus we can have some more economic growth. Now, again, there are social costs to that, and you know, happy to sort of discuss what those are, but from an economic perspective, this is a big benefit for the US economy. Ferris Bueller, we have not yet introduced our children to Ferris Bueller. We're not sure when the right time is to show them how to skip school, but I'm sure that will happen at some point because it was such a great movie that we enjoyed. But one aspect that of today's economy versus back then that's also very important is the level of globalization. So when we were pulling up these numbers, it was really just striking to see the differences. So back in the 60s and 70s, all of the global manufacturing, half of all global manufacturing came from the United States. I mean, the US was far and away the largest contributor to global manufacturing. And today we're talking about less than a fifth of global manufacturing produced in the US. Then when you look within the US, back in the 60s and 70s, a quarter of all of our GDP came from factories. And today it's about a tenth. Number of cars manufactured. I mean, again, think about how many more people we have in the US, how many more cars we have in the road, but we actually produce fewer cars today than we did back then. And then similarly, manufacturing jobs are almost half of what we had back then. And this is despite, you know, again, a very large increase in the dollar value of things that we produce. But between offshoring a lot of manufacturing and then what is onshored is so much more technology assisted and less labor intensive today than it had been. So a huge difference between then and now. And a lot of this has been able to happen because of just-in-time inventories. So this term just-in-time inventory became very popular about 20 years ago as companies were looking to really make efficient to not have like a huge amount of goods sitting on their shelves. They were able to develop these global supply chain systems that allowed them to really shorten the time that it took for them to put in an order and actually have it show up on their shelves. And this is a great source of efficiency for American companies. Now, the experience of the last 2 years really highlighted the weaknesses in there, because if you have this very long, complicated supply chain, it can work really well in good times, but then you have something like a lockdown in China, or you can't hire port workers in Long Beach, and everything gets really mucked up. So I think you're hearing more companies sort of talk about trying to rethink how they work their supply chains and either insourcing or near sourcing or friend sourcing more of their production. And I will admit that this is actually this sort of trend toward near sourcing, let's call it, has been slower than I would have expected given the tough experience over the last couple of years. But what's also protected US companies is the very strong dollar. So they're still able to buy things so much more cheaply outside the US than by producing it within the US. So it'll be interesting to see this evolve over time. So at the end of the Karate Kid, when Danny LaRusso is going to the Tri-Valley tournament, he's going to meet his nemesis, and he's been building up the whole film to kind of like meeting this guy in the ring and taking him down. And so Danny turns to his mentor and says, all right, so what are the rules here? What are we doing? And Mr. Miyagi says, don't know. First time you, first time me. And, you know, here's a guy who had spent his whole life training in karate, but this was different. this tournament was different from what he had experienced. And that sort of feels like where we are today, where again, a lot of shades of similarities, but there's a lot that's going to be new this time. So with that, let me pause. And I'd love to take questions. I always love to hear what's on people's minds. There is a button at the bottom of your screen that says Q&A. So feel free to click on that. You can type in your question, or if you'd prefer, you can just raise your hand and then I can unmute you and you can ask your question live. So let me stop sharing my question. I had to put the big hair photo in though. I couldn't resist.
Were any of those pictures you, Kara?
No, I would say I'm in the process of moving, which is why I couldn't produce my high school yearbook, but I wanted to try and find my actual yearbook and put it in. I'll have to do that as I'm unpacking.
Yeah.
My brother's usually very happy to supply me with embarrassing photos.
Brothers are good for that.
Yes. All right, so we're starting to get a couple of questions. What is the implication of simultaneous weakness in bonds and stocks? So the first implication is that people are freaked out. This is a unique period in that, as I said earlier, typically when we have stocks come down, bonds at least moderate, and they're able to really cushion our portfolios. And March 2020 was a great example where we had one of the biggest and fastest drawdowns in the market that we've ever had. But bonds were really able to kind of hold their own during that time period and moderate that downside. Well, the last 2 quarters, we haven't had that. So I think a lot of people are really scratching their heads and wondering why isn't it working this time? And it is really because of the uniqueness of the market in that you're having concerns about growth at the same time you're having concerns about prices. But I think also a big part of the simultaneous decline in bonds and stocks is also because of the speed at which all of this has happened. So, we talked earlier, and I've been describing this market since early March of 2020 as a market on fast forward. Everything is just happening so much more quickly than what we've experienced in the past. So the downturn in March, both in terms of the market and the economy, was the deepest and fastest that we've ever had. The rebound was the fastest and largest magnitude that we've ever had. And during that time period, it was like a lot of these traditional economic indicators just weren't working because they weren't fast enough. So, one of my favorite indicators is ISM manufacturing. And the reason why I like it is because it's monthly and it's very contemporaneous. Even that was not fast enough to pick stuff up. So we were looking at things like global search trends and location reports about where people moving around more. So just to highlight how fast this has all happened. And then as we come back to bonds, the reason often why bonds are able to manage through volatile environments is because as you have shorter dated bonds mature, you're able to then take that cash and invest it in a bond with a higher rate. So even in a rising interest rate environment, you're constantly like buying into bonds that are providing a higher rate. And so that provides your cushion. But here, when we've had this, Fed rate increase compressed into a very short period of time, you're basically pulling forward all of that. And you're marking down a huge portion of your book at the same time, whereas in other cycles, it would happen over time. We were just talking about this in our portfolio management meeting this morning. What that means, though, and here's the silver lining, is that bonds are so much more attractive today than they were 6 months ago. And the yields that they're offering are much more attractive. We haven't seen yields like this in quite some time. So if you are, holding your bonds to maturity and looking to reinvest, your portfolio is slowly going to evolve into this much higher yielding portfolio. So I know it's frustrating when you see these things all happening at the same time, but it also provides a lot more opportunity here.
So Kara, just as a follow-up to that, would you, with people that have cash on hand, don't want to go in the stock market, would you be buying into bonds right now?
I do think,
and realizing that maybe we're not doing individual bonds, right? We're doing ETFs, so we're doing mutual funds, does it still make the same sense as opposed to buying a ladder of funds?
Yeah, I do think fixed income markets are much more attractive today than they were 6 months ago. And as you said, if you have cash on hand, you're not quite comfortable taking on the risk in the equity market. I think it does make sense to start to step into fixed income. I actually really like investing in ETFs and mutual funds, even for fixed income. I think it's a great way. Bonds are even harder to sort of get a really diversified portfolio when you're buying individual bonds. And also, you know, there are so many risks out there right now in terms of convexity and credit, but having a manager sort of oversee that and make sure that your portfolio is properly diversified, leveraging an ETF or a mutual fund structure in that environment, I think is a very effective way to kind of step in for sure.
Is there a certain area, a part of the bond market?
You know, it's hard to say, right? Because it depends on kind of what your client's outlook is. Are you in taxable money, non-taxable money? In general, I think, you know, munis are in particular are looking quite attractive. Corporates, you know, some areas there are also looking very attractive. But in general, I think the most important thing here is if you do have cash on the sidelines, start to step back into the market and just make sure it's diversified.
Mm-hmm.
Oh, okay. So here's a good question. To what degree will the inevitable collapse of the cryptocurrency scam affect the markets? Not like you're opinionated about this. So it's so interesting. I'd say maybe 9 months ago is when I started getting asked all the time about crypto. And back then it was because crypto was going up, right? And everybody wanted to know, should they buy? And then of course, crypto started to turn down earlier this year. And then it was like, okay, why is it crashing? So it's been a very interesting sort of psychological dynamic. And in my mind, like if you think about this spectrum of risk, and you might have bonds over here, and then you have stocks over here, and then crypto is like way over there. And in my mind, there are two big themes that are driving crypto. One is this secular argument that having decentralized finance, having a more efficient way, a more private way of doing transactions will eventually take hold. Then there's this cyclical piece that I think people greatly underestimate, where with this very large amount of monetary stimulus, think about that risk spectrum. It just went up, right? So stocks went up more than bonds, and then crypto went up way more than everything else. And that's just that easy money finding its way into risk assets. And I think that part of the whole cycle has been underestimated by market participants. You can even still believe in crypto, and that's on a secular basis, it's going to get more adoption, and that, you know, 10 years from now, our kids are going to have crypto wallets and buy their Starbucks with it. And crypto can still be overvalued because of this just, you know, easy money that's going into the asset class. So, you know, I mean, you might think it's a scam. I actually think the technology has a lot of potentially really strong implications. You know, this blockchain technology, you're seeing a lot of companies adopt in some very innovative ways. But you can still have that and still see a lot of downside in crypto. So it's been very interesting. So OPEC recently announced that they plan to increase oil production by 650,000 barrels a day. How do you expect this boost in production to affect oil prices? So oil is also a super interesting market because there's the you know, demand piece, and that's certainly under pressure right now as the Fed increases rates, as economic demand starts to subside. You should see less demand for oil. But then you have supply, which is much more controlled than other markets tend to be. Now, the amount that OPEC has said they're going to increase is sort of under question because most OPEC members are about at their max capacity of how much they can produce. So there's a question about whether or not these countries can even produce the amount that they've promised. And then, of course, we have strategic reserves around the world where you're likely to see continuing increase in supply coming from theirs. But it's not like none of this is really likely enough to really ease the pressure on oil prices. In my mind, the pressure is we're gonna start to see oil prices plateau and then decline because of demand. And by the second half of this year, as we start to see companies get more cautious, individuals become more cautious, that demand side will come down, and that will provide, that will really ease oil prices. But it's going to take a little while to get there. This downturn seems to be an artifact of special circumstances, meaning COVID, Ukraine embargoes, etc., as opposed to true structural weakness in the US or global economy. Is that how you see it, or is there no real difference? I think this is such an insightful question. And that's what makes this particular cycle so interesting. So if you look at the health of the consumer, right, often we'll look at jobs, we will look at buying patterns, and we will look at their balance sheets or savings rates, right? So how much cash do they have in the bank? How much are they borrowing? So compare the health of a consumer today versus, for instance, 2008, we are in much, much better shape. In 2008, consumers were heavily levered, and then jobs just evaporated. So people were in very, very bad shape. And by the way, they were heavily levered in their home, which was very scary, right? With people being kicked out of homes. That's an extreme example of a really weak consumer. Today, we're sort of on the opposite, where depending on how you look at it, consumers are either back to savings rates that they were pre-COVID or even a little bit better. And at the same time, I know it doesn't feel this way, but most people's 401ks and whatnot are actually higher than they were pre-COVID. I know it doesn't feel that, but it's true. And then balance sheets are also very, very solid. We haven't seen a tick up in credit card spending. We're starting to see a little bit. We don't see aggressive mortgage lending. So and then of course the labor market is extremely tight. So in that sense, consumers are in a very good place. And then you can do a similar exercise with corporates where, leverage rates really haven't increased very much over the last couple of years. And by the way, everybody who does have debt, interest rates that they've used to take on that debt for the most part are much lower than they were 20 years ago. So the amount that you're paying out is lower. So those are like the big kind of structural issues that we look at that would suggest that, we're in pretty good health, which also tells me that if demand comes down, we're going to be in a pretty good place to be able to kind of muddle through that, because you don't have these like structural leverage issues that we did in 2008 and 9. Now, I will admit the big weakness is in sovereign debt. So the amount of borrowing that the US government has done, the amount that other developed countries has done. And so that's certainly something that, we look at very closely. But again, there too, like our debt service levels, so the amount that the US government is spending to pay off that debt is among the lowest that it's been since the 1960s. So there's a lot of room to go for us to be able to absorb higher interest rates and be able to pay that off. So, but fascinating. And then I'll just add on that point. So despite how healthy the consumer looks, confidence levels are among the lowest they've been in 20 years, right? So people are not feeling good. And I think a lot of that is because of inflation. I think a lot of it is also because of, political issues, but it's been very interesting to look at how consumers look, how they're acting, and how they say they feel are very different. So that's it for the typed in questions. Anything else top of mind for folks? Feel free to raise your hand, or Anne and Anne-Marie, anything on your end?
Yeah, I have a question. This is probably your favorite question ever. So I'm just going to Anne-Marie and I's favorite question, and that's the R word, the recession that's getting thrown out a lot, especially in the financial media. So what is your crystal ball saying, and what is your, position as a whole on maybe, it's never a question of if we're getting a recession, right? It's always a question of when, because we know that economic cycles produce recessions and expansions. So based on all of the information that we've talked about today, where do you all stand on when we may see a recession? And also the second point of that is, what does that mean from an investment management standpoint? Should we be making any changes? in anticipation of a potential recession?
Yeah. So yeah, it is my favorite question because I get it often. Well, that and where does the market bottom?
Yeah, that too.
So my two favorite indicators for a recession are the yield curve, in particular the 10-year yield versus the 2-year yield. And I was pulling it up as we were coming on here to see where we were. We currently, so the idea is like you have the 10-year yield here. Here's the interest rate that investors need to get paid in order to lend money for 10 years. And then the 2-year yield is over here. Usually investors want to be paid more to lend money for 10 years versus 2 years. And so when the economy is growing, the difference between those is really strong. And then as the economy starts to slow, these two will come much closer. And when the economy is worried, when the market's worried about a recession, then they actually invert. Right. So, and what that is saying is that investors are actually more comfortable lending money for 10 years than they are for 2, because they're worried that the economy is going to get into trouble here. And so right now, the 10-year and the 2-year are like locked together. I think there's like a basis point and a half of difference between those two. So, and if we look at back to like 1950-ish, every time we've had a recession, it's been preceded by the 2-year going above the 10-year. And it needs to stay there. So we've had like a couple of occasions where it went there for like a moment and then came back up. So that's one that we're watching very closely to see how long does it stay here. So is this like a reliable indicator? Now, it's not a good timing indicator. So anytime that happens, the US has gone into recession within 6 months to 2 years. That's a really big window. And by the way, during those periods, typically the market is up. So even if we know that a recession is coming, it's typically not a good indicator for what you do with your portfolio. So my other favorite indicator I mentioned earlier is the ISM manufacturing, because it's much quicker, right? We get those results within a couple of weeks of them being tallied. And that number, so 50 indicates that companies are saying, demand is about balance from what it was last month. If the number is above 50, it means that demand is increasing. Below 50 means demand is declining. So typically we need to have the ISM drop below 50 to about 46 to signal a recession. Right now we're in the mid 50s. So that is still telling us that demand is slowing, but companies are still seeing a pickup from what they had been in the past. So that my crystal ball is still telling me that we're not going to have recession. Now, we're going to have a very active Fed. The futures markets tomorrow are predicting a 75 basis point increase in interest rates. This will be the largest, I don't know in how long, and is much larger even than what we thought a week ago. So again, this is a market on fast forward. So that gets me to the question, to your second question, which is, well, what do you do with your portfolio? And so, bear markets are a part of the game. They happen periodically. We were long overdue last year for one. Now, as you said, we've had 2 in 2 years. So we're kind of, in some ways, we're getting it out of the way. We're now down 20% from the peak. Even if there's a recession, prior experience suggests that we have another 10 to 15-ish downside before the market starts to rebound again. So, and we don't know when that is. And the other likelihood is that we don't have recession and the market and the economy pick up from here. So given those circumstances, your best bet is to stick with your original plan, rebalance, right? So that's a really important way that you can take advantage of assets that have sold off. Make sure that you have the appropriate amount of risk in your portfolio, continue to invest on a regular basis. And kind of like ride through that and think about this as, a short-term stop, a tough stop, right? But one that does happen with regularity in markets, and you can never predict exactly when you're going to be able to come out of it.
And to be clear, Anne-Marie and I did not pay Kara to give.
Well, I'm glad. It sounds like we're being consistent.
Yeah, we definitely are. The other thing too is the job market, right? Because with unemployment so low, isn't that another that could potentially push the likelihood of recession out even further, right?
For sure. And not only that, we have among the tightest labor markets that we've had in modern financial history. We have the highest corporate profit margins that we've had in decades and decades. So when you think about those as like cushion, to withstand a slowing economic demand, we're in very, very good spot. So I expect, and so think about like corporate earnings at the beginning of this year were expected to grow in 2022 by 9%. That's a really rapid pace. Now, by the time we get through the second half of this year with economic demand moderating, my guess is that we're going to be below that 9%, but that's still profit growth for this year. And again, like when you look at the headlines, it's hard to imagine that we're actually coming off of peak, like, you know, very high profit margins, very tight labor markets. But it provides a lot of cushion kind of heading into this kind of more tumultuous environment.
Kara, if I could ask a quick question just on, so obviously we don't know, even if we have an inverted yield curve because of timing, whether recession happens or not. But when you talk about speed, right, the speed that we've seen in the last several years, both up and down, back up again, back down again. I worry that people get used to that. Oh, we're just gonna, you know, by the end of the year, we'll be back to where we were. And I think at some time, right, you're going to have that kind of reversion to the mean of a normal feeling cycle at some point. So is it not plausible, recession or not, right, that even the recovery could be slower moving? And what does that look like, particularly in bonds versus stocks, right? Because stocks tend to move a little faster up and down, but with bonds having such a dramatic pull, what does that look like in a recovery in that area?
This is such an important question, I think. And in fact, we were talking about this at our portfolio management meeting this morning as well, in that I think we do need to educate people in that it's not going to be like back to the races, right? Like that is the enormous speed at which markets recovered in 2020 was abnormal. It is not normal that we see that happen. And usually it is much more moderate, and you'll go up 2 steps and then back a step, right? That is a more usual market environment. And we think it is probably going to be exactly the type of market that you suggested, in that we will have positive returns over the next number of years, but they're going to be moderate, right? You're going to be kind of inching forward year to year. And in the bond market in particular for the near term, right? Because you still have this rising interest rate environment. It's going to take a little time for those portfolios to reprice into higher yields. But I'm a lot less worried about that today than I was 6 months ago in terms of like the forward returns for bonds. But I do think we need to kind of retrain ourselves. And like I often describe myself as the turtle, right? I would much rather have small gains on a regular basis and be able to reliably kind of grow a portfolio than go for those fast returns, because those are the types that evaporate like we've seen over the last couple of months.
I noticed that there was one more question, and God forbid we have a webinar not talk about politics. So it was just a quick question about change of party in the midterm.
Yeah.
You know that impacts anything in the near term, probably. Right?
So talking about politics has become ever more trepidatious in my career, but I'm a data geek, right? And that's where I go to kind of try and understand the impact of politics on the markets. And in general, and by the way, nobody likes this answer, in general, the party does not matter for what happens in the markets. Democrats don't like it when I say that, Republicans don't like it when I say that. But the president and the Congress actually have very little direct near-term control on what happens in the markets. And that's not to say what they do is not important. Over time, of course, they, you know, lay an important groundwork and infrastructure that the economy relies on. But it is very common that Congress will change parties after being controlled by the same party in both the White House and Congress. And it's very difficult to find any correlation between that happening and what happens in overall markets. Now, where there is a correlation is in terms of years of the presidential cycle. So typically in year 3 is when you see the weakest equity markets in a presidential cycle. And so that has been fairly consistent from one term to the next. But which party it is, it just doesn't matter.
Is that the case, Kara, for divided government? Like I seem to recall seeing studies where when there is divided government, the market may actually enjoy that more because that means that Congress is not at least doing anything crazy, right? We're not seeing,
No policy change.
yeah, we're not seeing massive changes to taxes or regulation or policy. Has that been your experience too?
Yes, that is a great point. And so in that case, it doesn't matter which party's in the White House versus the Congress. It's just that nobody's in control.
Nobody has too much power.
Yes, yes, and that has been fairly consistent.
Okay, well, we're right coming up on 1 o'clock, and just be mindful of everybody's time and Kara's time. We're going to kind of bring this to a close. Kara, thank you so much for your time and wisdom and data and big hair. Always a good reminder that, you know, the markets may be, you know, a little repetitive and cyclical. Hopefully the hair is not. We've hopefully learned our lesson in hairspray in the ozone layer. But anyway, I want to thank all the clients for that were able to join us. Thank you so much. I know a lot of people were disappointed that they couldn't make it today. So hopefully the recording, we can post it and get people out there. For those on the call, certainly Ann and I are more than happy to take emails or other questions. If you couldn't think of what you wanted to ask, or you were afraid to ask, or anything like that, always reach out to us. We're certainly here to answer those questions and help you feel more comfortable in being uncomfortable with today's market. So I'm sure we'll do something like this again soon, and hopefully with Kara. And oh, and by the way, look forward to seeing more of Kara in our website and in our commentaries with her markets in a minute, and some of the videos that Kara puts out that are really educational and helpful for all of us. So,
well, again, to that point, Anne-Marie, we have another video coming out today where I talk about my grandfather's experience in investing. So keep an eye out.
Great. Sounds wonderful. All right. Thanks so much, Kara, and everybody for joining us today. Have a great afternoon.
Thank you, guys. Take care.
Thank you, Kara.